At 3 in the morning on May 2nd, 2026, the Flight Attendants Union at Spirit Airlines sent a message to its 5,000 members saying they were delivering the hardest news of their lives. Spirit Airlines would permanently cease operations within hours. By the time most Americans woke up that Saturday morning, the bright yellow planes were grounded for good. Airport check-in desks sat empty. Customer service lines went dead. Passengers with upcoming tickets were told to stay home. 17,000 employees learned their jobs no longer existed. Spirit Airlines, once the largest budget carrier in the United States, had shut down completely, becoming the first major American airline to go out of business in 25 years. This is the story of how Spirit went from revolutionizing air travel for working-class Americans to liquidating its aircraft in bankruptcy court, and why the collapse was years in the making, long before the final blow landed. Spirit's origins have almost nothing to do with aviation. The company traces its roots back to a Michigan-based trucking operation called Clipper Trucking, founded in the 1960s. A spin-off air travel business launched under that corporate umbrella in the early 1980s, initially running leisure charter flights out of the Midwest under the name Charter One. The airline rebranded as Spirit Airlines in 1992, adding routes and aircraft and gradually transforming into a scheduled commercial carrier. In 1999, the company relocated its headquarters to the Fort Lauderdale area of Florida, positioning itself at the center of one of the busiest leisure travel markets in the country. For its first decade and a half, Spirit operated as a fairly conventional regional discount airline, competing on price but not in any way that fundamentally challenged how the industry worked. That changed in 2007, when the company made a decision that would define its identity for the rest of its existence and ultimately contribute to its undoing. Spirit formally adopted what the industry calls the ultra-low-cost carrier model, and the concept was deliberately aggressive. The strategy was simple: strip the base fare down to the absolute minimum, sometimes below what any competing airline would charge for the same route, and then charge separately for everything else. Carry-on bags, checked bags, seat selection, printing a boarding pass at the airport, a bottle of water on board, Spirit charged for all of it. The base ticket price was a headline number designed to attract travelers, and the fees were where the money actually came from. A Spirit fare that looked like $39 on a search engine could easily become $120 by the time a traveler added a carry-on and picked a seat, but that initial number was enough to get people clicking, and that was the point. The strategy worked, and it worked well enough to reshape the entire American airline industry. Spirit's ultra-low fares forced larger carriers to respond. United, American Delta, and Southwest all watched Spirit enter their markets and pull price-sensitive passengers away, with fares that looked almost impossibly cheap. The major airlines pushed back by creating their own stripped-down fare classes, the basic economy tickets that millions of travelers buy today, which offer lower prices in exchange for fewer amenities and no changes or refunds. Spirit had essentially dragged the cost of flying down across the entire industry, and the passengers who benefited most were the ones who had previously found air travel out of reach entirely. For a segment of working-class Americans who had never been able to justify the price of a plane ticket, Spirit opened a door that the legacy carriers had never bothered to unlock. Through the 2010s, Spirit was genuinely profitable. Load factors were high, meaning the planes were consistently full. Fee revenue was strong. The airline was expanding aggressively, adding routes and aircraft across secondary airports and high-volume leisure markets. The seats were tighter than average, and the experience was stripped down by design, but travelers who understood what they were buying got an extraordinarily cheap way to get somewhere. The ones who did not understand what they were buying complained loudly, which only reinforced Spirit's reputation as the airline people loved to hate. But the planes were full, the margins were positive, and the model was working. As recently as 2019, Spirit posted a net profit, and its stock was trading at levels that suggested the market still believed in the long-term viability of the ultra-low-cost approach. Then the pandemic arrived in March of 2020 and everything stopped. Spirit, like every other airline, saw its business collapse almost overnight. The major legacy carriers had enormous advantages in that moment. They carried billions of dollars in cash reserves, had access to massive government relief packages under the CARES Act, and critically, they had lucrative credit card loyalty programs that generated billions in revenue from bank partnerships entirely separate from ticket sales. When flying stopped, those credit card programs kept cash flowing into the major carriers, even while their planes sat idle on tarmacs. A traveler spending on a United Mileage Plus card or a Delta Sky Miles card generates revenue for those airlines whether they ever set foot on a plane or not. That structural advantage, which had always existed in the background of the industry, suddenly became the difference between survival and crisis. Spirit had none of that. The airline had no meaningful loyalty program generating independent revenue, and its cash reserves were thin by comparison. The pandemic wasn't just a temporary disruption, it was a structural stress test that exposed exactly how little financial cushion the ultra-low-cost model provided when the market stopped cooperating. By the time travel resumed in earnest, Spirit had lost more than $2.5 billion since the start of 2020, and that hole never fully closed. The recovery years brought a new set of problems. The major airlines had spent the pandemic upgrading their products and doubling down on premium offerings. When leisure travelers came back in large numbers, many of them were willing to pay more for a better experience. The basic economy model that the big carriers had built partly in response to Spirit now gave budget-minded travelers a recognizable brand and a more comfortable seat, often at prices that were not dramatically higher than Spirit's all-in total once fees were added up. Spirit's core advantage, the shock value of a dramatically lower headline fare, was narrowing in a way the airline had no straightforward answer to. At the same time, the merger that could have transformed Spirit's future was taken off the table by regulators. In 2022, Frontier Airlines approached Spirit with a merger proposal that made strategic sense for both ultra-low-cost carriers. Combining their networks, fleets, and cost structures would have created a discount airline large enough to compete more meaningfully against the legacy giants. But before that deal could close, JetBlue came in with a competing offer worth $3.5 billion, outbidding Frontier and persuading Spirit's board to accept. Spirit's shareholders approved the JetBlue deal in October of 2022. The Department of Justice sued to block it, arguing that the acquisition would eliminate a significant source of low-cost competition and ultimately harm consumers by removing the downward price pressure Spirit created. In January of 2024, a federal judge sided with the government and blocked the merger entirely. Spirit was left standing alone, without the Frontier deal it had walked away from and without the JetBlue lifeline that had been ripped away in court. Transportation Secretary Sean Duffy later called blocking that merger a massive mistake. The damage was already done. With the merger gone, Spirit's financial position deteriorated rapidly. In November of 2024, the airline filed for Chapter 11 bankruptcy protection, becoming the first major American carrier to do so since 2011. A reorganization plan was approved in early 2025, and Spirit emerged from that first bankruptcy that spring, announcing cost cuts, route reductions, and fleet changes meant to stabilize the operation. The airline cut nearly 4,000 jobs, eliminated 200 underperforming routes, and furloughed crew members across its network, ending 2025 with roughly 7,500 employees, down from 17,000 at the start of the year. The turnaround lasted months. In August of 2025, Spirit filed for Chapter 11 bankruptcy again, disclosing that it had substantial doubt about its ability to continue operating. A new chief executive, Dave Davis, who'd previously served as chief financial officer at Sun Country Airlines, had been brought in that April to navigate a path forward. Critics said the first bankruptcy had failed to make the structural changes the business actually needed, and that Spirit was heading back into court carrying the same fundamental problems it had entered with: too little revenue cushion, too few routes to achieve meaningful scale, and no answer to the credit card program advantage the major carriers held over every ultra-low-cost competitor. Davis would later tell reporters that the company had simply run out of time and, in his words, run out of runway. The final blow came from outside the company entirely. In 2026, military conflict between the United States and Iran sent jet fuel prices surging to levels that strained the entire airline industry. Jet fuel is the single largest operating cost for any airline, and when prices spike suddenly, carriers with thin margins feel it first and feel it hardest. For large legacy carriers with credit card revenue, hedging programs, and deep cash reserves, the fuel spike was painful but manageable. For Spirit, operating on razor-thin margins with no comparable financial cushion and no hedging program sophisticated enough to buffer a shock of that magnitude, it was catastrophic. The airline's cash reserves dwindled within weeks, and hundreds of millions of dollars in additional liquidity would be needed just to keep flying through the rest of the year. In the final days of April 2026, Spirit's leadership made a last attempt to survive. The airline approached the Trump administration about a government rescue package under which the United States government would have taken a 90% stake in the airline in exchange for the support needed to keep it operating. Administration officials engaged with the proposal, and President Trump, asked about a potential bailout on Friday, April 30th, said he was looking at it. By that same evening, it was over. A group of Spirit's major bondholders, including Ken Griffin's Citadel and Ares Management Corporation, rejected the terms of the government deal. A counterproposal from the creditors was rejected in turn. With no agreement reachable and cash exhausted, Spirit's board made the call to liquidate entirely. There would be no third bankruptcy filing, no new reorganization plan, no further negotiations with investors or the government. At 3 a.m. on May 2nd, the union message went out. By dawn, the planes were grounded. The immediate aftermath fell hardest on passengers and employees. Spirit had roughly 9,000 flights scheduled from May 2nd through the end of the month, carrying an estimated 1.8 million seats worth of reservations. Every one of those flights was canceled overnight. Passengers who had already arrived at airports found empty check-in counters and no staff available to help. The Department of Transportation moved quickly, announcing that United, Delta, JetBlue, Southwest, and American would offer capped fares on Spirit routes to help displaced travelers find alternatives. United reported rebooking 14,000 Spirit passengers onto its own flights within the first 12 hours. Frontier offered 50% off base fares across its entire network. For Spirit's 17,000 employees, there was no comparable relief. Their jobs were gone, and the planes, gates, and remaining assets would be sold off through the court process in the weeks ahead. The airline industry Spirit leaves behind looks fundamentally different from the one it entered. When Spirit adopted the ultra-low-cost model in 2007, it forced an industry-wide reckoning with pricing, and the travelers who benefited most were the ones who had never been able to afford to fly before. But the model carried structural vulnerabilities that became fatal the moment the external environment stopped cooperating. No loyalty program generating revenue independent of ticket sales. No cash cushion deep enough to absorb a pandemic or a fuel crisis. No merger partner after regulators blocked the one deal that might have made the business viable long term. And fares driven so low that when the major airlines copied the basic structure and added their own brand premium on top, Spirit lost the one advantage it had built everything around. The disappearance of Spirit Airlines means the 4 largest American carriers, United, American, Delta, and Southwest, now control roughly 80% of domestic flight capacity, a level of concentration that consumer advocates have already flagged as a concern for ticket prices on the routes Spirit once served. The downward pressure Spirit created on fares will ease on the markets where it competed most aggressively, and travelers on budget leisure routes who relied on Spirit to keep competing, carriers honest on price will be the ones most likely to feel that absence. Some of those routes may see meaningful fare increases within months as the remaining carriers adjust to reduced competition. Spirit Airlines crumbled because their business model was too fragile to survive the combination of a global pandemic, a blocked merger, industry-wide consolidation, and a fuel crisis it had no reserves to weather. Every one of those factors compounded the ones before it. By the time the conflict with Iran sent jet fuel prices surging in 2026, Spirit was facing a final unsurvivable crisis. Not a lone hiccup in the road, but the end of the road entirely. Thanks for watching. Don't forget to subscribe for more stories like this one.